Well, happy December 19th to everybody. I hope everybody's got their Christmas shopping done. You've got Brooks York, Jason Ferguson, and Katie Pruitt with AgriSompo for our December monthly marketing meeting. And Katie's way ahead of the crowd. She said that she's got presents wrapped. And yeah, I was kind of explaining to you earlier, when Santa Claus came to my house as a kid, the presents were just underneath the tree. We didn't have to wrap them. My wife, Santa just happened to wrap every gift that they open. So hopefully you guys don't have this big consternation in your house like we do right now. My kids are 21 and 18, and Santa Claus is still coming. I'm not sure how long that's going to be, but anyway, here this year, I can tell you that for sure. We've got a good little marketing meeting for you here. Going to be real informal. We're going to be very focused today. And as we go forward and have these marketing meetings, that's one of the things that you're going to see. You're going to kind of tune in to find out something specific rather than more of a more general message in the future as we roll into 2025. But anyway, to save everybody some time, we're going to be super efficient today. I wanted to talk just a little bit about markets in general. That's going to be the first thing. We're going to take just 3 or 4 minutes to talk about where we're at. Then I want to look inside the funding bill that's being proposed. And, yesterday there was all kinds of headlines early on that, we got a bipartisan bill that should go through relatively quickly. I mean, very quickly, because everybody's ready to get home to break. And then, of course, last night you saw President Trump and Elon Musk. I think the quote from Elon Musk was, "If you vote for this, you need to be voted out in 2 years." We'll kind of dissect what that means for our farmers as customers. And then Jason is joining us, and we're going to talk about the profit matrix. The profit matrix, the new and improved profit matrix, anyway, rolled out this Wednesday night in AgriNet, and we're going to put it to the test. And really, the link here is in the funding bill, and we're not calling it relief bill. There is relief payments for the situation farmers find themselves in last year and this year. And so we're really going to dissect how bad things look on the farm. And the profit matrix is a super spot to do that. And in the meantime, Jason, we're going to throw in a lot of different strategies, whether it's band, ECO, SCO, all the multi-perils that we can throw in. And seeing the situation we're in, we're going to look for the best combination of insurance products to protect a farmer in these tough times. So without further ado, we'll get started. Yesterday was a horrific day for soybeans. We saw soybeans down 25 cents. We broke through major support levels on January beans that were somewhere in the upper 960s, right in that 960 to 975 range. We blew through those. We went down. We're trying to recover a little bit today. Last check, I saw January beans up about 5, March up about 7. The situation on beans sounds like a broken record. We're going to have considerable carryouts forecasted for this year. And we've already got one crop in the bin, so to speak. That's the U.S. crop from last year. And we're going to have another crop in the bin in February. Conditions in Brazil have been described as ideal to maybe slightly too wet. We hear the old adage, rain makes grain. Certainly with all these rains in the growing season, which we're in the middle of right now, that's a pretty good combination for yields. Yeah, maybe too much rain could affect the very top end yields, but it certainly makes for a solid crop, and the market knows that. There's more rain in the forecast. It looks like a wet forecast according to the European model. As we move a little further south and we look at Argentina, Argentina looks more in line to feel the effects of La Nina than Brazil does this year. Most meteorologists agree with that. What does that mean? In La Nina years in the past, there has been an average of 9 to 11% decline in yield. And when you take a look at that, while that's a significant decline, it's a big decline. With what's going on in Brazil, it does not significantly change the balance sheets. What do the balance sheets look like? If we forecast out, and I give everybody a warning here, when you try to guess crops size and usage a year and a half out, good luck with that. It's not going to happen. But with average crops in the U.S., um, and Brazil this year, it looks like we could tip the scales at a carryout somewhere around 900 million. We've seen that before, believe it or not. If you go back to 2016, 17, we had a carryout that big. We also had extremely low prices in beans. And so the two go hand in hand. Now, there are a lot of things that can happen. And one of the things that could happen in the commodities world involves wheat more so than soybeans right now. And we do have some areas in the world where wheat is under a little bit of stress. Of course, that's the Black Sea, Australia, and not so bad here in the U.S. Things are actually a little bit better than they have been in the past few months. But when we look at wheat and we really dig down into it, the big problem is geopolitical. And this is going to be this, I think, will take major headlines over the next 6 months. I had some graphics that I showed the last marketing meeting where it's estimated that when we take a look at where the world is conflicted, and I talk about, Israel, Syria, uh, Ukraine, Russia, about 22% of the world's production comes directly from these areas. Now, they may be lesser producers like Kazakhstan, Uzbekistan, um, Poland, Ukraine, Russia, of course, a big producer, Ukraine, a sizable producer. Also, some of our customers in this area, like Egypt, could be affected. And so wheat looks like it's oversold. It looks like we've got problems across the globe enough to put the market on edge. Maybe wheat is the driver for commodities over the next month. We'll see. When we take a look at corn, corn this morning, I read an article that said it's quietly bullish, and I think that's a pretty good way to look at it. Pre-election demand, which we talked about with Dan McNeil in the November marketing meeting, was really good. It was from our traditional buyers, Mexico, Colombia, South Korea, Japan. They stepped up and they bought quite a bit. In fact, while I don't have supply and demands on here, there are some outlets that think our export number on corn could be around 2.4 billion bushels this year. That would be the highest estimate. Most continue to set around 2.2 billion. So we've whittled carryouts down on corn from around 2 billion, which I would say is burdensome, down to around 1.7 in the December WASDE report. And so while corn hasn't rallied wildly, it certainly hasn't gone the same direction that beans have. So some opportunities there. Um, if you're talking to producers, if producers are looking for advice here, it's really, really a tough time to pull the trigger on beans, but not a lot of hope in sight. I think maybe patience might be the best strategy on beans. Basis levels are extremely strong across most of the country, especially on the river system. When we look at corn marketing, I think this is a good time to make some corn sales. March futures, May futures, July futures. If your producer doesn't have an operating line, if they're not borrowing a lot of money, take advantage of some carries out there. I think there's a fair amount of corn moving to town. Just looking at the lines in river towns like St. Louis, looking at lines in Jeffersonville, Indiana, Shawneetown, Illinois. Farmers are definitely moving this corn, which tells me there may be some opportunity in the summer months, especially around ethanol plants, to capture some pretty good basis levels. We'll see. In other words, corn's leaving the country early for cash concerns right now. If you've got that guy that's flush with cash, holding it may not be a bad idea, even though the market doesn't necessarily have the numbers in it right now. I think the basis will come back in that May, June, July time period. Wheat, wheat's kind of interesting. And if you know me, I'm pretty conservative on marketing advice, but wheat looks like a commodity. I can't believe these words are coming out of my mouth, but in the marketing world, there's something called courage calls, where farmers actually go buy call options before they've got it sold. I hate it. I absolutely hate it because it goes against everything that we've been taught as hedgers and hedging 101. But if there was ever a time to probably try that strategy, it might be now. In other words, have the right but not the obligation to buy without selling that crop that you've got in the field. May not be a bad time. And like I said, I can't believe I'm saying that because I never, ever give that advice, but it certainly looks like it could be justified. So a little rundown on commodity markets, and if you've got questions along the way, shoot them at me. But what I really wanted to show you before we jump in the profit matrix, I've done some rough spreadsheeting on what I can discern out of this relief bill. I want to share that at this point in time with you and walk through it. Now, don't be bashful to ask questions, and at the same time, um, my disclaimer is this is you can see this is as good as the information I can glean from what little information I've got out there. As best I can tell, I have not seen a House resolution number on this bill. So a lot of what I'm going with is almost more hearsay than anything else. But we do know some formulations, and so I'm going to walk through these real quick, kind of show you the method of the madness. So in the bill itself, as best I can tell, there's about $100 billion that are earmarked. And again, give me grace on this because we're trying to pull information as we can find it. Of that, there's a large percentage that essentially just keeps the government rolling as usual. In other words, they're dollars that would normally already be spent, but there is some relief in there, primarily around hurricane relief. Now, this hurricane relief looks like to me it's about $40 billion. Some of that money inside the hurricane relief will go to farmers in affected areas. As a side note, I believe that this relief portion of hurricane relief will actually get spread out to 40 different states. You can make of that what you want to, but on the part of the bill that is going to impact what we do, there's around $10 billion earmarked for relief for farmers in a challenging revenue situation. And these are the formulations that I can come up with. And literally, I kind of sat down for 2 or 3 hours and really just kind of made sense of the madness, pulled numbers out myself because I didn't want to rely on anybody else's numbers. So let's walk through these. Again, a big asterisk at the bottom that says, this is information as we found it. I have not found anything released from the government yet that shows the detail. But let's take a look. For corn, the first few things that we look at is we look at the 10-year average. The 10-year average yield is 173.33 bushel per acre. Now, the marketing year average for 2024 was 410. That may seem pretty low. You may say, well, that doesn't really correspond with futures. It's not supposed to. Remember what that marketing year average is. It's September 1st through August 31st. It's supposed to represent the average cash price sold by farmers across the United States. So it's a lot of states. It's weighted. So if you're in an Iowa, Illinois, you obviously get more of that price average because that's where the majority of your bushels are at. Now, the 2024 cost of production was $879.10. Our 2024 revenue was $710.65 for a net return of $168.45 loss. Okay, think you can follow with me on all those numbers. Then there's a payment factor. So far, I cannot tell you where this payment factor is derived, but it's 26% for all commodities. There's also another reference. There's also another price point of 8% of the reference price equals 30 cents. So when you kind of do the math, you can go back and look at reference prices for the year. 38% of that is 30 cents per bushel. So there's two calculations, okay? And essentially, you get the greater of the two. And 8% of the reference price here on corn, 30 cents, multiplied by the 10-year average yield results in $52, okay? You'll see I've got two bold numbers here at the top. The 52 is highlighted because it is greater than the 43.80. How did we get the 43.80? Well, we take 26% of the net return loss, and that is $43.80. The greater of the two will be the calculation. That's 8% of the reference price, 30 cents per bushel times 173.33, which is over here, the 10-year average. So I hope that's clear as mud, okay? But that is the number with some final numbers I've seen other places. But I really wanted this group to kind of to look at it and see where we're at. Now, I can't see the chat box right now, Katie and Jason. Does anybody have anything in the chat box so far? I'm going to walk through all these commodities very quickly, Jason, before we talk profit matrix. Is there anything I'm missing out there?
No, there's nothing in the chat box right now.
Okay, awesome. Good. Cotton, okay? And cotton is, it's a different scenario than corn. When you look over here to the right, you see I've got a different highlighted box. Let's walk through it real quick. 10-year average on cotton, 861.8. 2024 marketing year average, 66 cents. 2024 cost of production, 2024 cost of production, 894.56. The revenue, 568. You see a big loss here, $325.70 net return. All right, let's do the math here. We're going to take these two blue shaded areas and we're going to take 26% of the loss. 26% of that loss is $84.70. Now we weigh it versus 3 cents, which is 8% of the reference price. We multiply that times 861.8 over here, and you get 25.34, which is the greater of the two. It's the 84.70. So on cotton, it looks like for 2024 planted acres, 84.70. I did not highlight this next one, and I need to. We're just going to kind of talk about the final numbers, perhaps on these last ones, and then I'll show you one caveat that sticks out versus all the rest. You'll see I've got one blank, and I'll show you why that is. When we come down here to oats, or it's barley actually, and barley, you'll see that there's nothing here, and that's because there was actually a positive return when we looked at the marketing year average cost of production and yields, and we saw a positive return. So 26% multiplied by zero loss is zero. And so that's where we default to the 8% of reference price of 40 cents into 71.8 bushel the acre is $28.72. So I'm going to pause there. But the highlighted boxes are what I think is proposed in the bill as it stands today. I would say written, although I haven't seen it. So 52 on corn, 84.70 on cotton, 33.34 on soybeans, 31.80 on wheat. Barley, we just went over, 28.72. Rice, 84.36. Oats, 80.14. And peanuts, 83.63. These are the primary row crops that I've seen outlined so far. I'll stop there and stop sharing my screen. I will send this out to marketing reps across the country. Jason just asked a question of when we'll be voting for this. Jason, here's my take on it. I think we're going to vote pretty quick. I think it's not even out of question that they don't vote on this today or tomorrow. That's my take. They're wanting to get home for break. Remember, this is really not a bill designed to, it's a funding bill to keep the government from shutting down. That also has relief in it. You see how convenient that is. And yesterday, if you read the headlines, I mentioned it right before we went on the air. President Trump, Elon Musk, I think Musk made the statement that if you vote for this, you should be voted out in 2 years. I thought Speaker Johnson's comments were interesting when he said, at this point in time, yes, the Republicans have control of the House, but we don't have control of the Senate. We don't have control of the executive office. It's really important. So with a looming shutdown, sure makes a lot of sense for this to get passed. Now we'll see what happens. President Trump's influence has surprised me in the past. we'll see what happens on it. But I think sooner rather than later, Jason, is the answer to this. When you look at government shutdown date on coming up right around the corner, when you look at a recess for Congress right around the corner, would make sense for this to happen relatively quick. We'll see. Speaker Johnson's kind of put himself in a corner here. He's kind of given his nod on it. And there's a lot of people that are going to be pretty aggravated on both sides of the aisle if there's some renegotiation at this point in time. Any last questions on that? Tommy, you've got some expenses out there. Okay, I see those. Those are going to come in handy here pretty quickly. Jason, I think it's time for you to make your debut on the monthly marketing meeting. We're tickled to have you. I described Jason as the wizard behind the curtain on a lot of projects, but especially on the profit matrix. He and I have been working on this for probably, Jason, last 9 months. And he's done the vast majority of the heavy lifting. The cool thing about Jason is he sees that things get done from an IT perspective, but he actually understands how agents use these in the field. So he brings a great perspective on the profit matrix. Jason, I'm going to let you take control at this point in time. I may come in and pop in questions that I think the audience wants answered, but tell us a little bit about the profit matrix.
All right, good morning, guys. Bear with me here. I'm suffering from a bout of the man flu, as my fiance describes it, which I think has been defined as minimal symptoms, but absolutely devastating to me. So we're working through here on that. But yeah, so this morning we're going to talk about the profit matrix. So we've got Brooks policies pulled up here, and kind of in terms of how to get to the profit matrix. I think we rolled this out last week. I've gotten some questions from the field on like, hey, you said we rolled it out, but how come I can't access it? The user guide is going to be published on Saba this week. If it's not there already. I know I saw some emails about that. I saw a few emails about that this week. But basically, when you enter the matrix here, you pick a county crop on your policy, and then you hit more, and then you hit profit matrix. So this is the route we chose to navigate into the profit matrix here, simply because we wanted to make it very clear to everyone that you're only matrixing one county crop at a time. Right. So looking here at 2024, I have Brooks's policy here pulled up with 2024 acres, just to kind of try to illustrate some of what he had talked about as far as like the expenses viewed in his farm for this year. So we've got this. This is the acres on his acres report this year. We're just going to keep these the way they are, right? No changes here. And I do hope that this will provide good information to your growers as far as, kind of how their cash went in 2024. Looking into 2025. So the functionality that we have kind of in our quota already is here. You can use the prior years, you can copy value, you can add a line. Those things all exist here as well. And then we get into this expenses section. So one of the things that's cool about the profit matrix, I think the whole project is extremely cool, but it's kind of the thing that I've thought about for the last 6 months or 9 months every time I got out of bed in the morning. So anytime you have keyed expenses, they save, right? So in 2024, I have done this demo for Brooks's policy a couple of times. These are the expenses that we keyed in the last time. So what we hope this means for you and your policy holders is if you sit down and break these out itemized for them every single time, they will continue to be here the next time you enter. I think Tommy's got some expenses. Brooks, do you mind reading those off for me?
Yeah, chemicals, and let me give you a brief explanation. I promised everybody to be brief today. We may go a little bit more over my estimated time, but so this is all your sides, right? Your herbicide, your insecticide, your fungicide. It's also got some application in there. And whenever I get a bill, one of the things that's challenging is to actually break apart the machine hire and the chemicals. So maybe I'm a little sloppy on my accounting side, but I throw them all together. And, you know, that 115 seems excessive, but you got to understand it costs $15 to $20 for aerial application on fungicide. In some cases now, we're going to 2 of those in the year. Far enough south that there's a little bit of pressure with insects and fungus late in the year that it seems to be worth it. It's also got all of your herbicide application cost in there. So 115, it kind of gives me enough for 1 fungicide application. And in some cases, some of my fields get 2 now, 1 at brown silk and 1 usually that first week of August. Discounts and freight. Now, this is one that's neglected in a lot of cases because few people pay a freight bill. Now, if you're hauling your own crop, you've got other expenses, right? You've got a truck, you've got fuel, you've got drivers. But if you have a custom haul job done, then it's going to cost you something. A lot of times it's deducted from your settlement at the elevator. But if you take 200 bushels, the acre, times, say 30 cents a bushel, which is what my rate is here, um, that's $60. So Jason, I think you may have 50 on there. It's kind of hard to see. The screen is pretty small. I'm using the zoom feature, folks, too. If you guys want to use that on your thing, you can kind of make it bigger. But let's go to 60 there. Fertilizer. This is going to be my nitrogen, my phosphate, my potash, any starters that I've got. I'm running around $270 an acre. Put all those on myself, so there's no application in there. Operating in, if you borrow money and you're in that 7 to 8.5%, boy, this $25 may be light. Some people use house money, and if you use house money, you have no operating interest. This doesn't include any interest for equipment, anything like that. It's just operating interest. Seed cost, using around $113 an acre. You can look at seed cost in my area range from $280 to $300 a unit for the most part. We go down to non-crop insurance. Might be a little high. Jason, let's drop that down to 25 bucks. That's going to be, actually, let's drop that down even a little bit more. Let's drop it down to 15. It's going to be kind of a glum or general liability umbrella, along with some auto maybe thrown in. There's always some legal and accounting. Um, $5 is what I threw in here. Licenses for your trucks, your trailers, I put $5. I threw a little maintenance line budget in there at $8. If you go down below, I left machine hire. Off for right now. And then in the miscellaneous supplies, professional fees, I've got some equipment costs built in there. And the way I look at this is I look at my principal and interest payment. I also look at any supplies I buy. I think most people on their equipment, principal and interest are going to run, there's a few cases where there's no payments on the farm, but a lot of folks probably average around $40 to $45 an acre. The one thing that really gets away from us, and I think it does a lot of farms, is repair and maintenance. And if inflation has changed the game on anything, it's the price of parts, the price of repairs has seemingly gone sky high. And so $50 an acre is what I use for repair and maintenance. Usually, if you've got employees or you've got a living expense or draw, I'm throwing in $35. Some folks don't throw anything in there, but we're giving an accurate look here. We'll put real estate taxes. Let's drop those down a little bit, Jason, because we're spreading those across the entire farm. Let's just say $10. Utilities. What's in utilities? Maybe dryer gas, it may be cell phones, it may be trash service, it may be electricity, bins, irrigation. Bins seem to always have a cost with them, irrigation too. So we built this budget out, and Jason, I think the only thing we really missed is land cost. And so you take a look at land cost, and for our neck of the woods, land cost is probably the most challenging cost to calculate, and I'll tell you why. You've still got some 60%, 40% crop shares out there. It's really tough to know exactly what that cost is. We know exactly what it is. We know exactly what it is when the price changes, when an expense change. You think of all the things that go into that. It's not 40% gross per acre. It's 40% of that acre. Subtracting 40% of the chemicals, subtracting 40% of the fertilizer or any other cost that the landlord takes on. You've also got land that maybe grandpa had paid for. And while a lot of people say that, you need to charge yourself a return on investment, I know very few farmers that do. So that land essentially goes into the mix of zero. And then you've got the easy one to calculate, and that's cash rent. So for practical purposes today, we're going to use $200, the calculation. So Jason, I think you've got me there on expenses.
All right, so that brings our total to $1,008. So when we jump over here to coverages, this to me is kind of where all of, once we've been diligent about keying accurate expenses, this tab begins to paint a picture on what is happening on the farm. When we look at our total expenses here, and then we have a couple of numbers that are probably going to look, probably never seen these before, right? So this risk percentage, this is a number we have decided to calculate. And what it is expenses divided by projected price times weighted average approved yield. So when we take 466 times 214 and we divide it, we divide the sum of that by 1008, we get 101% of risk. So what that is intended to do is to give you guys an agent, as an agents or growers, this is kind of my target level of coverage. So in this case, and I think we all kind of know in discussions with expenses looking at 2025 crop year and to a certain extent 2024, these haven't been profitable or super profitable years. So we are trying to maximize our amount of coverages, dollars of revenue with our insurance plans. So we can start here and we can say, okay, let's do a 85% RP policy, right? And then let's add another one. Right. So let's also do let's do like 75% with SCO. And then looking at this, there's another kind of, if I'm trying to get to 100%, let's just do that one. And then let's add a new coverage. And then we say, okay, let's look at this RP with the SCO with a 75% level. But then let's add some coverage here like ECO, right? That's a way to fill in another 9% gap, right? So that gets us to effectively 95% of value per acre for your coverage amount. And then let's use our bands and let's get a little clever here. And let's say, okay, let's do SCO, ECO. And then let's also do a revenue band. But instead of doing a 95-50, 95-10, because that's going to be expensive, let's try to get that 100% of crop value in a different way, right? So let's do a 85% trigger with a 14% coverage range. So this is effectively adding additional revenue that doesn't start to pay until you get to the 85% level. So this is ensuring kind of, actually, let's do this. This is your own bushels plus ECO, or I'm sorry, plus SCO. So this gets us closer to 100% here. And let's add another one. Let's look at you can add up to
Jason,
5. Yeah, go
when
ahead.
you finish this, is there one? Can you throw one up there without any insurance at all?
Yeah, so by default we have the no insurance, right? And this is something we found that would be, we wanted to make sure we included in this to just to illustrate the effectiveness of the farm bill to kind of our lobbying friends. So when we get to this point, right? So here, these are our results, and yes, we do have a no coverage option, and we can show it in a second. When we look here, this is kind of the first time, at least here at AgriSompo, that we've taken kind of a suite of coverages, which is the term I've decided to use for the kind of bundle of multiple coverage levels under one coverage suite. Need to find a better word for that, but it's the one I'm using for now. And looking at, coverage option 2, you've got $26.87 for the premium. You're guaranteed $856, and your risk protected is 85%. So you are covering $856, which is 85% of your $1,008 that you had keyed in your expenses.
One thing that Jason you point out is what we're trying to do is we're trying to sell. So there's consternation, right? There was an old product that we had out there. I think it was called the Optimizer. I'm not sure, but essentially it went back and it almost sold claims. Okay. And it tried to pick the strategy based on 10 years that was going to be most likely for claim. That wasn't the approach we want. We also don't want the approach of uh, selling policies based on premium. Okay. Um, that's really not the right approach either. Kind of taking a new approach, Jason, of trying to pick like a combination of products. And think about this. Think about all the curveballs we've been thrown at. We've got SCO changes, or perhaps changes. ECO for sure. We've got changes there. That changes our ARC PLC decisions. So many things that this tool can kind of sift through that. But my point in talking is I like to start on the right and work my back to the left on this screen. Jason, give them an idea why it's important to start with risk protected and then effective rate and work left.
Yeah, so when we look at this risk protected, we see here that kind of the only suite that I have quoted that guarantees close to 100% of the risk is also the one that is the most expensive, right? And I recognize that, and we're not trying to hide that. But when we look here, you know, this revenue band with a 14% coverage range and an 86% loss trigger is the only one that gets them anywhere close to that $1,008 per acre for expenses. So when we look at risk protected, it's coverage per acre divided by expenses. And then the effective rate, and the effective rate is something that I just like love. This is one of my favorite ways to look at policies. The effective rate is, you know, for every $6.10 a premium I pay, I get $100 of coverage. Obviously, 75% SCO has the lowest effective rate here of the ones that I've quoted. You know, probably the lowest would be 50% RP with SCO. It would give you the most amount of dollars per coverage with the lowest premium. So that's what that effective rate is doing. And then we look back at the next one, coverage per acre, followed by premium per acre. And when we look at this, when we're here, we've got 5. We can print this straight away, right? And what this does, and I'm going to do this one first here. I think this is the less cool way to display this, but it definitely depends on your sales strategy and whether you meet your growers in the office or in the field. When we look here, the first one here is the no coverage option, and then
Let's stop right there for a second.
Yep.
Okay. If we're in Washington D.C. and we're educating lawmakers and staffers, this is the first step that we're at. Okay, Jason, when we look at deep losses on that first matrix right there, um, that chart in and of itself justifies crop insurance the way we do it. And a lot of people say, you know, we're the envy of the world when it comes to our crop insurance system. We are, but look how catastrophic it is without crop insurance. So we kind of start there when we're educating folks in DC. Then all of a sudden we move to the different strategies. And in a lot of cases, we're teaching folks really for the first time, you know, how RP might work. And check this one out. It's pretty complex, right? It's 75%. And then we've got SCO. So we use this kind of information to educate legislators through our acre PAC group, you know, pretty much pretty consistent throughout the year.
So as we run through this, these are kind of all of the options, right? You can see kind of worst case is no insurance at a 707 net loss, and we also can adjust these headers. I can go back and show you how to do that. And then the other thing about this, I did this one first on the compare modal. I will show you how you can mouse over into each one of these, and we will show you the math. Because showing the math is very important to me. I don't necessarily like that. Sometimes we just show black box numbers. I want you guys to feel confident in these numbers that you're putting in front of your growers and what they mean. And then finally, the last page here is essentially this is your expenses, right? Like when you're going, you give this page to your lending person and you say, hey, look, here's what this is going to cost me depending on this plan, which plan of insurance I take, here's my worst case scenario. And have the ability to show this data to kind of your lending institution. So that was one of the things that we wanted to make sure that we had. If you keyed this data in and you were thoughtful about it, we want you to be able to provide that information to the banker kind of in one step. And the other thing when we look at this is we have quoted a lot of options here. RP with SCO and ECO and revenue band and in this, our takeaway document that you can leave with your growers 5 pages and the last page is expenses. So we wanted to keep this kind of short, something that is bite-sized to rather complicated products, just to say, hey, here's, I want to leave this with you. You can obviously customize these headers and whatnot, but this is what I'm leaving with you. I hope this makes sense. And I hope this helps you to make a decision, right? So when we jump back in here, that was kind of like well, I'm going to my farmer. I want to print these 5. I'm going to take this document with me to the field, and that would be that sales strategy. Versus, hey, let's take a look at this on the screen, right? I got a grower who's coming into my office. I'm going to so what crops practices conventionally? So
I'll take care of that one on the chat box, Jason, for the sake of time, and let you continue on.
Yep. So this compare modal. We can update our headers here. We can also update them on the previous screen. But when we look here and we say, okay, what does this number mean? So we've got in this cell we have SCO indemnity, RP indemnity, revenue band indemnity. So this is the data, right? And then when we look here and we say our 1008 plus 6066, that is our premium for this plan of insurance. And that hopefully helps to illustrate what exactly we are doing here. Oh yeah, so I'm sorry, the fourth number is
as I type this, I'm going to hesitate real quick, response to Andy's question, but when you see these on here, folks, I've seen these matrices look like this a handful of times in my career. There's a tremendous amount of red on here, and the reason why I wanted to, transition from that, call it what you want, about relief payment into this is to really kind of show the current situation. Now, every part of the country is going to have a different looking matrix. Every farm is different. Jason, you talked about this a little bit last week when we were in Dallas, as the difference of the farm. And so, if I'm an agent, tell me why I need to be cautious about kind of a cookie cutter approach, and tell me how important the expenses are to picking the right products, if you don't care.
Yeah, I mean, when we look at this and we look at specifically that 1008 number, right? That was our expenses. Yeah, the easiest one for me to pick on is land use cost, right? So if we take that out and we say all of this farm is 100% owned and the land use cost is, 30 or 40 bucks for taxes. When you start to look at these numbers, everything here becomes green. Right, when you increase this 71 by you add 160 to it, all of a sudden they're making 90 bucks an acre. I don't do math well in my head, but I think that's right. So when we look at this, and this is why I think for the purpose of the tool, right, is to create a framework for our agency partners to ask these questions and figure out what the expenses are. And then allow our agency partners to be the ones who say, hey, I can help you with this, and kind of in all circumstances, I can either make this number maybe not look so bad, or I can make it green, right? And when we look at this one in particular, this was an 85% revenue band. So here in the middle, these numbers are still pretty big, right? So a shallow loss, you're still losing a fair amount of revenue, right? So then we have an opportunity to say, okay, what are you afraid of, and how do we architect a coverage package to help with the risk that you are most concerned about? And having that on screen when they're in the office, and here's a good example. Let's change this bushel increment to 25. Let's keep it at 214 at 100%. Let's update this. And let's look at these things when there is a greater loss, like you 18% of APH. Here's what this looks like, and illustrating what they're concerned about, and then trying to provide a level of risk management that these growers maybe are not accustomed to having, as far as what we have typically done.
For some of you, this may be a rerun that you've seen in the past, but I'll be honest with you. This profit matrix, I think, changes perspectives a little bit of what grouping of products we have. Other thing is it makes it really concise, Jason, whenever we're looking at SCO, ECO. We've got a disclaimer out there that, SCO, ECO is going to be based on a factor that we're not going to know about for a long time, and that's the actual county yield. But you have to start someplace, and I think this profit matrix has given us the best tool that we've had so far when dealing with supplemental and enhanced coverage options.
Yeah, I mean, and when we look at the bones of what this is right now, right? Like, we've left real estate here to potentially show final county yield. Everything we do right now for ECO, SCO, we're using harvested bushels for county. Kind of, if there is time, right? Like, this is I work in IT, and it's always, there's more ideas than developers, but if we can get some time here, the next phase of this becomes input county expected final county yield here, right? So then we can say, okay, I may harvest 100% of APH or 110% of APH, and I can just raise this number to do a larger one. But my county trends 20 bushels below my yield. So I can input this final county yield at 20 bushels below. And then you can begin to see, okay, here's how we can look at these county products better, right? And that's effectively what this tool is trying to do, right? It's trying to illustrate things to our agency partners in the most effective way, so that you guys can explain these complicated coverages that do not feel like they're ever going to get easier to your growers in a way that makes sense. So
So, folks, I have promised 30 to 40 minutes, and we're kind of coming up on 50. I've also pulled Tommy out of an important meeting to be here. Jason, do you care to kind of use the same scenarios but build a different expense tool
sure.
that kind of lays out some expenses?
Yep.
And I'm sorry to cut you off. I
No,
apologize.
the one thing I would say real quick here before we jump to that, this is the report off of the compare modal. When you have one on the right side and one on the left side, this is going to illustrate kind of both of them overlaid on each other. And it will shade them for in this option 3, these are bigger numbers, and in this option 4, this is a better outlay.
I love that feature right there.
Yeah.
Because it
So
kind of allows you an insight into the farmers and what they're worried about, and picking the right strategy.
all right, so let's look at these expenses.
Tommy, if you're there, you may be muted. I'm not sure.
Oh yeah, hey, yeah, you want me to list them out for you?
Yeah.
Yeah, I think that would be just great.
All right,
Just kind
awesome.
of throw them in there with Jason.
Yeah, courtesy of a buddy, Ryan Goose, one of the co-founders of Bushel. So West Central Minnesota kind of gave me a rough estimate this morning when I asked him. So we got chemical $40, and this is corn costs. Let's see. I don't know if I got the discount freight, that kind of stuff, but I know he had miscellaneous of $10 there if you want to throw that in. 120 on fertilizer. Seed was 55. I don't know if we throw in the crop insurance part or not for premium. He's estimating $15 an acre. Fuel, oil, lube, $40. Repairs, 38 bucks. Drying, 35. or if you want to throw that in bins or not. Miscellaneous 10, I already said that. Interest about $8 an acre. It's got some machinery depreciation and investment around $50. Miscellaneous overhead $12 and roughly about 180 of land charge. And then I don't know, calculating any kind of basis, in that area, it's roughly 40 to 50 cents basis. I don't know what the futures price is looking like right now, 431 or something like that. But APH's corn for his corn was 180 roughly around his operation.
All right, so
So,
what's this?
so
I
this
know
structure,
yeah, I know I missed a few there. What's our total?
I think we're around, 600, 610, 620, somewhere around there when I added it up.
All right, because I know I missed a couple. I'm just going to stick 100 here and other. That gets me to 628.
as a disclaimer, I will say this, and Tommy, I'm not saying this about your numbers. Most farmers estimate very light on it. This is one thing that at the end of the year kind of catches up with them. Oh, did I spend that? To kind of give you an idea, on this farm, this would essentially, their operating interest would say they're borrowing on average every day $100,000 off their line at 8%. So kind of give you that idea of how much it would be. If this is a 2,000 acre farm, your repair and maintenance would be around $76,000 a year, which seems pretty accurate. The seed cost, I don't know what populations or seed they're planting there, Tommy, but that would put the cost of a bag of seed down around $150 an acre. So I don't get that seed that cheap in my area. I'll trust that these numbers are right, but they seem awfully light to me.
Okay. And definitely could be. I mean, I called him quick this morning. Hey,
Yeah, it's off the cuff. But to my point is do your homework behind these, because if you do meet with a farmer, sometimes you might need to ask some probing questions on getting these out.
for sure.
All right, so looking at 628, let's just kind of forecast. What's the spring price going to be, Brooks?
Let's just say it's going to be 425. I think it'll be better than that, but let's just go there.
All right, so now we can see our risk percentage here. At this 214 with this 628 for expenses is 69.
Can you move your APH to 180, or is that something that can be moved?
So I can't do
Because it's based on
that
policy.
because it's based on this, but I can do some Jedi mind tricks here to get it closer to there. All right, so we put acres in the 175, right? So that's going to effectively change our weighted average to 175. So now we're closer to that 184% risk protected. So now we can quote, that we're just quoting in lieu of time. We're just quoting what I had previously, and this will give us some kind of new data. So looking at these, it looks like that was a noteworthy APH because it was significantly cheaper for the cost of insurance. And then we have this ability to matrix these again. We're just going to compare. We are comparing no coverage plus option 2. And then we can just kind of look at this and figure out what is our.
I can tell you right now, Tommy, I'm farming in the wrong part of the country.
Yeah.
Yeah, it might be. It's snowing here though. I don't know if you want to be in North Dakota right now. So
Yeah. You win some, you lose some, right, Brooks?
That's right.
All right. I mean, this is kind of, with these new expenses, here's what our options are. Coverage 4 was kind of the one that was the most expensive with the revenue band. So when we look here at our numbers, the 194 is the value of sold and unsold grain. So 105 bushels at $1.85 ought to be close to $194 plus RP indemnity of $364 plus ECO or band indemnity of 82. I don't remember which one is first, and then 104 is the other one, and then minus your 628 for expenses plus your 49.91 in premium equals net profit and loss of $66.
So, guys, let's go back and look at the options on the page that you don't necessarily like, Jason. Let's start right there. Let's remember right to left on here. If we don't look at premium, let's pick the two most favorable. Tommy, um, take a look at those and take a look at effective rate, risk protected. Just gander at those. Pick the two that you like right off the bat.
Uh, I'm gonna like the the better effective rates, the top two, when you're looking at that in terms of premium cost and premium uh, per acre. I don't know if that's the right or wrong answer, but that's
So what's your perspective on it?
Yeah, I mean, so in this example where kind of all of them are covering 100% of risk, I like option 2 or 5 as well. It just depends on, the next thing I would look at is susceptibility to prevent plan. The 80% coverage option 5 has a bit more PP guarantee if needed. Um, that's what I would look at as well.
Yeah, I like it. And in a lot of cases, the scenarios won't look like this. So, when we look at risk protected, all these are over 100%. Again, expenses might be a smidgen light on here. We got some things that we can't control. We don't know where the county yields are going to be. But in a lot of cases, we're going to struggle to get to that 100% risk protected on the vast majority of policies across the country. I'm with you guys. I think if you can cover your cost, even though the effective rate is lower at the top, I'm going to go with the 102%. Definitely, if you look at the top three, the first two look the best because it's got a higher risk protected and a lower premium in combination. You look down at the bottom, and it really all depends on where you want that top end to go. But in a year like this, I couldn't agree more with you, Jason. I'm going with option 2 or 5. So let's put them to the test. Let's compare them to each other. Can you select those two and put them on
Yeah.
on the side by side?
So I should have checked the second one. Yeah. So, I mean, then here we go, right? Like this is your two options that we've selected, and let's go ahead and say, okay, well, my weighted average approved is 175 here, but I think my strategy here, I think we can go bigger. So let's do 225 bushel increments to go, see, because my APH is 175, but I know I'm planting a 200 bushel crop, and in looking at this is where we're at. And then we can put,
Pretty interesting there. There's a lot of things that you just don't get from the matrix. I think Jason, he's thinking like an agent here and thinking about, I think you mentioned maybe replant, is a side conversation that you have out of this. But if I look at these two charts, I'm probably saying, you know what? I think I'm going with option 2. That's my take on it. My red numbers, a little bit more modest than option number 5. And my top end, not a lot of difference. Looks like more opportunities for profit. It's probably how I'm going to make that decision. Tommy, how would you, when you see these and you take these out, and if you put yourself in the agent's position, I mean, what questions might you ask here, as far as like the farmer's concern? How would you tackle that? I know I'm putting you on the spot here, but what are some of the questions you'd ask?
I definitely, when, thinking around and comments around, the expense budget or whatnot, it's like you had mentioned before, it's kind of some probing questions that, hey, is this, are we thinking a little light here? Let's maybe overestimate a little more on some of those so we get some more realistic, expenses, just to aim on the high side, right? But yeah, when looking at coverage option 2, the cost of everything is a concern. I know folks are gonna be more apt to want to spend less premium. It's also got to be careful though, because in these times, all right, it's probably best to put more coverage on, to really make sure that you can operate in the future. If you have that one bad year, you want to make sure you got the insurance in place to cover those.
I think that's great perspective. Well, guys, we're at an hour mark, so I really apologize, but we've had good, strong attendance through this whole thing. This is just really to whet your appetite. We got folks in the field, our marketing reps, our regional marketing managers be happy to walk you through this. I'm really excited about it. Andy asked the question, what crops are out there. Without getting too detailed, corn, beans, wheat, we're keeping it pretty conventional right now, but this is an ongoing process. So we're going to see crops added. We're going to see types added as we go. We're going to crawl before we walk on this thing, but I couldn't be more excited. I think that if there is, we kind of hit the jackpot, and I say that kind of jokingly, with the changes that the proposed farm bills on both sides of the aisle have put out there in regards to SCO changes. It feels if and when there's a farm bill passed, there's going to be significant SCO changes. We've already seen subsidy rates change on ECO. So when we can throw those two factors in there, I think and his crew, they have done just an absolutely wonderful job on being able to calculate some of these things that are so hard and abstract to take out to the farmer. And again, while it's not perfect, it changes the conversation that an agent and a farmer have. So it's cool to have this tool and really look forward to what it can do in the future. I wish I had a lot better news on commodity prices. It's challenging right now. Just keep in mind, you can be pretty surprised on commodity prices. A couple different changes on the globe, and things can do just opposite of what you think they can. Whether you wrap your presents under the tree from Santa or just put them out there, everybody have a great Christmas, and we'll see you guys and gals again in January. Tommy, Jason, Katie, thanks for all your help. We're going to wrap it up. Tommy, Jason, any final thoughts for the crew as we sign off?
One thing I would say is, if there's any feedback you have on this tool, please get it to your marketing manager to get to me. I mean, we're open to that, and we want to make sure that we have a tool that suits what you guys need.
Yeah, likewise, any and all feedback is greatly appreciated.
Katie, thanks for engineering this thing. And again, Merry Christmas, and we'll all see you in the next year.